Hi, everybody. It's Leslie with the New Mexico Small Business Development Center, and I'm here today with Tommy Thompson. Tommy Thompson is a SCORE counselor who specializes in business and corporate financial planning and business valuation. His 40-year career includes experience in international consulting, manufacturing, software, and high-tech hardware. Tommy earned a bachelor's degree from Hamilton College of Clinton, New York, and an MBA from Rutgers University. He is a licensed CPA, now retired in New Mexico and New York, and was formerly accredited in business valuation in the American Institute of CPAs. In retirement, one of Tommy's key business interests is a voiceover actor and announcer. New Mexico Small Business Development Center also wants to encourage all small New Mexico businesses to learn about the risk of ransomware and to protect your data and how to do that. We have a series of cybersecurity webinars that are available on demand, pre-recorded, up on our YouTube channel. I will chat over that link to everyone today. Remember, if you have any questions, please type it into the Q&A, and I'll make sure that I ask Tommy at the appropriate time where we can get those questions answered for you. So with all that being said, I'll turn it over to Tommy Thompson.
Leslie, thank you very much, and good morning, everybody. As she noted, I'm Tommy Thompson. Leslie did a great job of introducing me, so unless you have questions, that'll have to suffice. We've muted everybody's audio for convenience and to keep the barking dogs to a minimum. And if you'd like to see this in the best light, make sure you set your zoom ratio to fit window. That will fill your computer window. As Leslie said, we will be using the Q&A function here to take questions. Please write down the slide number that your question is about so we can get back to the right place, and then write your question down for us as well. What we're going to do today is to talk a little bit about NMSBC's training offering and counseling assistance. We're going to talk about our objectives for this program today. Then we're going to talk about the program today. And then we're going to take questions and then talk a little bit about next steps you can take to maximize what you're getting out of today's presentation. First of all, the training and counseling assistance. If you go to the www.nmsbdc.org website, you can find training offering schedules, and you can find a request form where you could apply for no-cost business counseling and loan application assistance. That's nmsbdc.org. Now, today, what are we going to talk about? We're first going to define what is cash flow, what it makes it go, what are some of the strategic principles behind it. Then we're going to talk about forecasting cash flow, because what we're really interested in is not what our cash flow was yesterday. We're really interested in what our cash flow is going to be tomorrow, next week, next month, next year. Then we're going to talk about some tactics. What can you actually physically do specifically to help your incoming cash come in faster and to keep your outgoing cash going out as slowly as possible to conserve your business relationships? Finally, we're going to talk about some record keeping requirements that are associated with most of the pandemic relief programs that are out there. The PPP, the EIDL, you'll learn what all those mean. The New Mexico state relief programs, they all require you to have available records because they all have audit provisions where the state or the feds can come back later and say, okay, you did all this, show us what you did. Now, first of all, I want everybody to remember that above all, cash in your business is king. It is the lubricant that makes business run. And when you run out of cash and you run out of the ability to meet your obligations when they're due, or even past when they're due, you're going to crash because you don't have any lubricant anymore, and the wheels of business just grind together and stop. Now, first of all, what is cash flow? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. A little more formally, cash flow is the net amount of cash and cash equivalents. That's stuff that's just like cash, being transferred into and out of a business. At the most fundamental level, your business's ability to create value for you and any shareholders you have is determined by that business's ability to generate positive cash flow over a long period of time. Okay, that's the more or less academic definition. I lifted it from Investopedia, which is a website that you can look at your leisure. Now, what is cash flow? What goes into cash flow? First of all, easily enough, it's cash money coming in. It's sales in cash over the counter. It's collections on credit sales. If you do business on credit with any of your customers, your sale to that customer going out is not cash flow, right? Because you didn't get any money. But when they send you a check, that's cash. It's deposits from customers against special orders or future services. It's prepayments of subscriptions for things. It's pandemic relief loans and grants. Now, they don't go into your P&L statement, but they are cash coming into the business. Finally, bank loans, loans from you back to the business, and also family, friends, and fools money are all things coming into the business. Now, they're not accounted for as profit and loss, and we're going to talk about the differences. But those are the things, those are the cash things that come into your business that provide you with that lubricating oil to keep doing business. Now, cash flow going out, of course, is compensation, what you pay your employees, what you pay yourself, the employee benefits that you pay for, the payroll taxes you have to withhold from your employees and pay yourself. It's also your payments to vendors, people who've dealt with you on credit. It's rent to the landlord. It's operating expenses, whether you pay your advertising agency or your insurance broker or any of those kinds of operating things. It's also repayment of things that aren't in your profitability statement. Remember, cash flow and profitability are two different things. Bank loan repayments, capital equipment purchases, money that you draw out of the business, whether it's as compensation or as distributions, profit distributions, and also repayment of loans or even dividends to family, friends, and fools. Now, it's different from profitability because there are more sources of cash than go on your profitability statement. Profitability is all about sales to customers, right? And there are more uses of cash than go on your profitability statement. When you repay the principal of a bank loan, that's not part of profitability. It's part of financial condition, but it's not part of profitability. Now, what isn't cash flow? Simple. Cash flow is anything operating in your business that doesn't require cash to move. If you sell to somebody on credit, the cash hasn't moved. If you buy from somebody on credit, the cash hasn't moved. Now, we accountants call this the matching principle. We match up when the transaction took place to when it's reported for financial reporting purposes, for profitability purposes. But it doesn't mean that the cash flowed at that point in time. So always keep that in mind. If the cash didn't move, it's not part of cash flow. Now, what's a basic cash flow strategy? First of all, you have to be willing to work at it. In the same way that you work at getting new customers, in the same way that you work at selling to your existing customers, in the same way that you work at figuring out how your business can do better, you need to have cash flow in that thinking cap of yours all the time, because you have to work at it. If you don't work at it, it falls to the bottom of your priorities list. It falls out of your mind and you don't pay attention to it. So you got to be willing to work at it and make it part of your top of mind business activity every day. Second thing, you need to forecast cash flow. And you need to forecast cash flow because you have to be able to tell your story to the stakeholders in your business, the stakeholders being your creditors, your banker, your customers, all the people that you need to keep your business going. You need to be able to tell them the story of what you expect to happen. To do that, you've got to forecast. Now, you also need to have to be able to track your cash flow, because if you forecast it and don't track it, well, how do you know what happened? How do you know if it really did happen that way? Because tracking your cash flow against your forecast and figuring out what the differences are, trust me, there will be differences. That's what provides you with the story you can tell your customers, your creditors, and all the people you need to talk about your cash flow to in order to get your customers to pay you faster, in order to get your creditors to wait a minute and take a little bit or a little bit less or wait a few weeks. You want to also look at those things that accelerate the cash coming in, that get it in absolutely as soon as possible, even before you provide the goods or services, if that's possible. And you also want to slow down the cash going out of your business. You want to slow it down to the maximum extent that you can and still maintain good relationships with your vendors, with your stakeholders, with your banker, and so on. So that's the basic strategies. And we're going to talk about implementing those in a fairly tactical way this morning. Now, forecasting. Let's start with forecasting. Yeah, I know. We do have to start with forecasting because that gives us a basis of information based on assumptions at first, of course, but it gives us a basis of information to say, okay, this is what I expect is going to happen. And if these things happen, I'll be fine or not. And I have to find some new source of cash. Okay. But we start with what's your cash now? What's in the bank? What does the business have available to it this instant? And then we add to that what we expect to come in over the period we expect it to come in on. Now, I tell all of my clients to forecast cash flow for a 12-month period rolling forward. Now, what does rolling mean? Rolling means I do this every month and I update my forecast every month. I don't just create a 12-month forecast and then say, okay, now it's, I created my forecast in January. Now it's July. Well, what happened between January and July? Are there any lessons there for me in telling me that maybe I should modify my cash flow forecast going forward? And every month of experience that you have gives you a little more experience and information to forecast and change your forecast based on what you've actually experienced going forward. When you forecast the cash, you figure out what's coming in. Why is it coming in? First of all, because that tells you whether it's part of profitability, which you very much want it to be, or whether it's part of debt or other programs, other sources that you have some strings attached to that you've got to account for later. Then you want to ask yourself, okay, I know what I have, I know what's coming in. What's going out? Why is it going out? Why am I spending this money? And when is it going out? I may not have to pay it today, but I know that 3 months, 4 months from now, 5 months from now, or quarterly going through the year, I've got to come up with certain kinds of payments. Maybe my quarterly payments are for payroll taxes. All right. Maybe my monthly payments are payments against goods I bought the previous month or the previous 2 months. Okay. Now, when I add my cash today together with what's coming in and what's going out, I get a forecast for what my cash is going to be then at some point in the future. And again, if you do this on a rolling 12-month basis, you've got a forecast that says, okay, at the end of the month, I expect cash to be this next month, cash to be this the month after, right? Now, how do you forecast cash? You forecast it with a model and you build a model. Now, you can build your own model if you'd like, but on the SBDC website that you can download is a copy of this model, which has all the add and subtract calculations and placement calculations and all that built into it. I'm going to use a non-working version of it here just to explain what it is that we're doing, provided I can ever find my little, oh well. We start with what looks like a profitability schedule, except it's got a couple little twitches to it. Up there at the top, instead of having revenue on the top line, I've got my beginning cash balance. What's my cash now? At the start of January, my cash is $10,000 in this example. All right. And then I go down through it and I record things pretty much as they happen according to the way the accountants want me to. All right. This is key because we start with something that looks very much like a profitability statement. We have revenues, $15,000 in January, and we have a cost of goods sold. This is the cost of the inventory cost of the stuff that went out. All right. And then we have a gross profit line. We're all familiar with that from a P&L statement. Then we have operating expenses. Also looks like our P&L statement, right? totals $4,770. Now, there's a couple of things that aren't in our operating expenses for the month. And those things are explained over here on the left side in the bottom. We haven't included any interest expense. We haven't included any tax expense. We haven't included any depreciation. If we have leasehold improvements or machinery and equipment and stuff like that, we would normally record a depreciation charge each month. But when we record a depreciation charge, have we spent money? Have we put cash out the door? No, we haven't, have we? So that's the reason for eliminating depreciation and then amortization, which applies to intangible assets. Now, we'll talk about the interest and taxes and how we account for those in our cash flow forecast in a minute. But right now, just think of this as pretty much your profitability statement that does not have any interest or taxes or depreciation in it. When we go to the next slide, we now start to account for the interest side, because when you see where it says debt service under section 2, debt service includes the principal and the interest. Now you can separate them if you want to and show the, note 1 principal, note 1 interest, and note 2 principal, note 2 interest, that sort of thing, if you'd like to do it that way. And your accountant might actually tell you to do it that way. But for your purposes, it's one thing. It's debt service. It's cash going out the door to the bank. And so we account for it here. And notice the brackets around that. It's a deduction because it's cash out, right? In section 3, we talk about investments. And those investments are generally thought of as expenditures for capital equipment, capital type expenditures, things we buy that are going to last more than a year. Now, this is for accounting purposes, remember, because the tax code now lets us write off some of that stuff completely as if it were an expense in the first year. But we're talking about accounting now, all right? So in this example, in January, we spent $100 on something that we were going to keep for more than a year and we thought was worth capitalizing as a fixed asset. Out here on the third page, section 4 wraps all this together. Because first of all, our cost of goods sold, we had stuff that was in inventory, right? It came out of inventory, it went to the customer. Now, how much cash moved with that? We had recorded the cost of the inventory earlier, and now we just took a box off the shelf and sent it to the customer. Did we get any cash? No. So we add back the cost of goods sold, but we take out what we actually spent to create that cost of goods sold this month. For example, inventory purchases. Now, this applies more or less to a retail type business, but if we had a manufacturing type business, we would be deducting not only inventory purchases, we would also be deducting cash that went out the door for direct labor, cash that went out the door for manufacturing supplies, cash that went out the door for factory overhead, utilities for the factory, and so forth and so on. All right. So it might not be, if you're in a manufacturing business, your cash flow model might not just have one line in it, it might have several. Now, sales. We made the sales in accounting terms, and we probably made a batch of them on credit, right? So we got to take out that sales line too, don't we? But we add back the sales we made for cash during the month and whatever our customers paid us on account of sales we made to them last month or the month before. You follow that? For example, if 90% of your sales are on credit, then you're going to only have a few $100, in this case, $1,500 worth of sales in cash during the month. But your customers you sold on credit to last month, many of them are going to pay you this month. Some of the ones that you sold to 2 months ago are going to pay you this month. One or two of the people you sold to 3 months ago are going to pay you this month. And there's one or two deadbeats that won't ever pay you. Nah, we have to put up with that, right? So the cash collected from sales and the cash collections on accounts receivable, we add back into this cash flow. These are what are called timing differences. And we're accounting for those timing differences here by taking out the accountant determined numbers and putting in the cash determined numbers. The next line is estimated tax payments. All right. Now we've got to pay payroll taxes, we've got to pay payroll withholdings, we've got to pay estimated income tax and all that. That's usually on a quarterly basis. This reflects a January payment of $3,000 and an April payment of $2,500. All right, quarterly, basically. Now the next line talks about changes in accounts payable. Now, when we change accounts payable, if we let accounts payable go up, that means people have given us credit, and in effect, we've had cash flow in. If we decrease accounts payable across the month, that means we paid it down somewhat. That means more cash went out for it, right? So in January, we paid down our accounts payable by $500. In March, we let it rise up by $750. And then we paid it down again, $500 in May and $500 in June. And those changes in accounts payable get recorded as a cash flow item. Now, I've left a couple other lines in there to let you put in what it is that you need to put in as far as any other changes and any other timing differences. Now, the totals in section 4 are that in January, it's a negative $375. Well, if we look back to section 1, we saw down there that our EBITDA, this is our profitability before interest, taxes, depreciation, and amortization, is about 6,480. Well, that's 6,480 minus the 4,375 and the other two items back here, section 2 and section 3. That all nets together to a net cash flow for the month of $905 positive. Good thing, right? And our ending cash balance, $10,000 at the start, plus $905 during the month, we're having ending cash balance of $10,905. Now that's the end of January. If we look back here at the start of, February, I found my little cursor. What do you know? At the start of February, that's the same number that we had at the end of January. Well, so that stands to reason, right? No time elapses between the 31st of January at midnight and the 1st of February at 1 second after midnight. And then we repeat the whole process over again and come down. This time we had a good month in February. We had $4,700 of cash come in the door. Net of everything that went out. So we have $15,605 at the end of the month. Now, I'm going to plug in my laptop here. Hang on, because it just told me it was going to run out. And now we can see how this flows from month to month. 15,605 at the end of February becomes 15,605 at the start of March, and so on, and so on, and so on, all the way across your 12-month forecast. Now, if you're in the business, who kind of business that budgets things for the year, you can use your budget numbers in these section 1 lines and in the section 2 lines and section 3 lines pretty easily, can't you? And that's one of the reasons that this works this way, is because now you can transfer your budget numbers in, know where they went, know how they come out. And this section is the important section where you forecast what your collections are going to be and so forth. Now, how do you forecast collections? Well, look, you know how many people that you sell to on credit that pay you within 30 days. On average, it's probably 85% of them. Another 5% of your people, maybe it's 65, 55, 60% of them. Another 30% of your customers pay you in 60 days. Okay, so you've got 80% or 60% of last month's sales plus 30% of the previous month's sales. 5% of your customers, 8% of your, let's call it 8% of your customers pay you in 3 months. So now you've got 8% of 3 months ago sales. And you just roll that forward. Okay. What happened to the other 2%? Well, they're the deadbeats. And those are the ones you're not going to collect from. We'll talk a little bit about how to minimize that risk later on. But for now, you've got this way now of forecasting your cash flow right through that 12-month period that I talked to you about. Now, some businesses decide that they're going to maintain a minimum cash balance. There's 2 reasons for this. One is the bank might require it. The bank might say, you will, as a condition of this loan, keep X dollars in our bank continuously. All right. You won't let your balance fall below that. All right, fine. Other ways, businesses have said, well, what if we have an awful month next month and there's a big bump? And for no fault of our own, our forecast is just knocked into a cocked hat. Well, we want to have enough cash on hand so that we can meet our needs during that month without having to go to the bank, without having to basically crash because we ran out of cash. And so we can meet payroll. Different companies define this differently. You might say, for example, that that 2 months worth of cash flow or 3 months worth of cash flow on average is what you need to have in the bank. That's fine. That's the way to do it. For this business, in the example here, we just plugged in $8,000 as a basic, got to have that much in the bank cash number. Okay. Now you compare that to what your real cash is at the end of the month. And now you find out whether you need to go borrow money on your line of credit or talk to your banker about a line of credit, or whether you need to think about what you can do with this excess cash. You can start to think about now about paying dividends. You can start to think now about that process improving equipment that will improve your profitability. You can think now about launching another product line and the cost of doing that. You can think now about an extra special marketing campaign or so forth. All right. Or you can think about going back to your family, friends, and fools and saying, we're going to be a little short this month. I'm not going to pay your dividends. And oh, by the way, can you loan me $1,000? Good luck. But that's the kind of thing you have to think about. Now, the nice part about it is, as I said, you can go to the SBDC website and you can pull this off, and it's all got the lines for you there. All the calculations are in it. And all you have to do is plug in your numbers to make sure that you've got a cash flow forecast. And as I said, you roll it forward 1 month each month. It's a rolling 12 months. I don't care how you're going to do for 2021. We're halfway through it. All right. But I do care how much cash you're going to see coming in 8, 9, 10, 11 months from now. Okay. So that's how you forecast the cash. Now, against that, you've got to track it. All the major accounting software that's out there, and QuickBooks is the most popular one, but there are other programs. All that software allows you to create a profit and loss statement, profitability, right? It allows you to create a balance sheet, your financial condition. And more importantly, it allows you to create a cash flow statement. And most of those are set up similar to what we've just discussed in that cash flow forecasting model. At least track your cash flow forecast against your forecast. Track your period that you're actually accounting for against your forecast period. I mean, that's a better way to say it. Track it by a month, or depending on the business you have, if it's a very stable business, you could track it by quarter. But in an emergency, you might want to track it day by day or week by week, because if it's that critical, you're going to want to create expectations for yourself. In the 1980s, I worked for a company in the outdoor power equipment business. That's lawn and garden equipment, like lawnmowers and lawn tractors and garden tillers and stuff like that. And our particular product was a garden tiller. If any of you have heard of the Troy-built rototiller, then you know what I'm talking about. Well, we would sell rototillers with big ad campaigns that spent a lot of money in December and January and February. And people would start buying rototillers, usually from the south to the north, beginning in February, late February, early March, times like that. So we would spend a lot of money and then have a lot of money coming in. That would, in the spring, as you might guess, was our big season. By the end of June, we were pretty much done selling new tillers for the big part of the season. We had another little blip in September and October when we did some promoting to get people to buy, because they could then till their leaves into their garden and improve their garden soil. But we had very high cash flow in at certain times of the year, and we had very high cash flow out at other times of the year. Our manufacturing, we tried to levelize, so the factory workers were working pretty much steadily all through the year. So we would build inventory and build inventory and build inventory from April, May, June on through September, October, November, December, January, and then that inventory would go out the door. But our cash flow was critical, and it was very much tied to the marketing campaigns. Now, back in pre-internet days, we marketed by direct mail. You'd send out a mailing, a promotional mailing, and then anywhere from 2 days, 3 days, 4 days to 6 or 7 weeks later, you would get either more inquiries for information or you would get orders. We liked orders. And so that way, the marketing people could build forecasts and say, well, in our experience, this is what happens when we mail this mailing, the one in January or the one in December or the one in February. And they would forecast the order flow. And then our accounting folks, the group I was responsible for, would forecast when we expected the orders to get shipped, so we could then budget each month going through the year. And more importantly, we could measure the cash flow. The the marketing people tracked orders day by day. So they knew if day 1 or day 3 or day 5 didn't hit what they showed it should hit based on past experience, they could alert everybody and say, we're lagging in orders. And they would report this on a weekly basis, basically. There was a daily flash report that we put out that had numbers on it, like the number of orders we got and the amount of cash we had in the bank today. And that kept everybody focused on what the cash was in the bank. So if you need to do that, if you're tied to a marketing campaign or you're tied to your advertising so that you can forecast based on what you dropped, it's called, then that's a great thing. And you can track to your experience with that. Now, what do you do practically? What do you do to get the cash in faster? There's a number of things that you can do. And the first of them is the one you're used to. That makes it easy, right? Just sell, sell, sell. Analyze your existing customers. Analyze what they're buying from you, when and by how much. Then call them up. Don't wait for them to order. Call them up and say, would you like some more of this? Or I see you bought this stuff last year. You haven't bought it yet. Would you like to buy it now? I'll give you a good deal on it. Call to offer them more of what they've been buying. Also call to offer them related products. I see, Mr. Customer, that you bought XYZ last year. Did you know that ABC is intended to supplement that and go along with it? Would you like some? We can make you a good deal, right? Offer pricing discounts for fast payment or even discounts for cash with an order. Now, I know it's pretty common if you sell on credit to offer a, say, 210 net 30, 2% discount for paying in 10 days. Okay. That's very common. But you could also say, if you send us cash with your order today, we can give you 5% off, or whatever number makes sense for you, right? Whatever you do in this sales process, do not stop marketing and prospecting for new customers. Those are the customers that are replacing some of the customers you used to have that no longer buy from you. Whether they found, and the reason is immaterial. It's whether they found somebody else, or they went out of business, or they retired and sold the business and the new guy has got different vendors. Doesn't matter. You're going to lose a few customers every year for whatever reason. You still have to continue to market and prospect to try and get those new customers in the door. And that marketing and prospecting includes marketing and prospecting with your existing customers beyond just the sell, 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 sell. All right. You want them to think you care for them a little bit as more than just a customer buying things, right? You take care of your customers, right? You do things for them. Now, cash flow in can be accelerated also by using just one bank to get your cash in. Try and, for example, if you sell on credit cards, try and get your credit card processor into a position where it's either part of the bank you're using or very close to the bank you're using, so that you get overnight credit for credit card sales. Then, if you have to borrow, match the type of loan to what you're paying for. For example, if you need a revolving credit loan to support your accounts receivable, well, that can be a revolving credit line where you pay it down when your customers pay you and you let it float up. You take advances against it when you've sold to your customers, but they haven't paid you yet. Okay. Similarly, if you're going to buy a machine that's going to work for you for 6 or 7 years, finance it over 6 or 7 years. And that way you've got a level payment each month, and presumably that machine is working steadily through each month. All right. When you have to borrow, but match the type of loan to what it's paying for. Now, collect your receivables faster. That's easy for me to say, right? Well, there are ways to use professional collection techniques to do just that. For example, you could tighten your credit requirements, which means you reduce the amount of credit that your customers are open for, which means they have to pay you faster to stay within bounds, right? They have to pay you more often. You can also take credit cards. You can say to some of your customers, I can't deal with you on my credit, but I will take credit card from you. All right. And that is often a tool you can use with very slow paying customers. There's two alternatives in that. One is something that used to be common in the personal computer building business. That was that you could take a COD company check. In other words, that was credit for the people who were selling to you, because they were very nervous that your check would bounce. That was credit for them. COD, give them the check when the goods are delivered. Or just credit card with the order, no credit at all. Just you give them the credit card, or you give them cash with your order, and then they send you the goods. You also have to follow up. Once you've put that good or that shipment out the door, you need to be tracking when the invoice is due, and you need to be calling and following up your customer, not in a threatening way, or not in a excuse me, hectoring way. Excuse me. You have to call them up and just say, hi, how are you? How's things going? We noticed that you've got some invoices due in a few weeks. We just wanted to ask if you expected that they were going to be, you were going to be able to pay them on time, if you plan to pay them on time. We need to know for our cash flow forecasting process. And by just calling and following up, you become the top of mind vendor for that customer, because you're the one that's showing that you're on top of them, that you know what you shipped them, that you know what the terms are, that you know what you're expecting of them. And you're just asking, are we okay? Can we expect to get it on time? Now, you can also use a bank revolving line of credit. Most bank revolving lines of credit are based on some percentage of eligible receivables. Eligible receivables are typically those under 90 days past due. So if your line says we'll advance you up to 80% of your accounts receivable that are less than 90 days, then you can calculate what that borrowing limit is, and you can take from it up to the limit of that borrowing, so that you can get the cash in as you need it. I shipped $100,000 worth of stuff today. I can take $80,000 off my revolving line. Of course, all revolving lines have a ceiling. Okay, if you're at the ceiling, shipping $100,000 worth of goods doesn't mean you can get more money from the bank, because you're at your total relationship ceiling, it's called. Now, there's another means of cash flow acceleration coming in. That's called factoring. Now, this is a very common process in the fashion industry, where department stores and so forth order in large amounts of clothing and orders for the fourth quarter. Usually that's when department stores make all their money. That's when retail stores make all their money, is the 3 or 4 months that lead up to Christmas, starting usually in September. But those stores want those collections shipped to them during June and July and August, so they can get them on the floor, so they can sell them. Well, but the customer isn't going to pay until they've sold them in October, November, December, and on after season sales in January. So to survive, a lot of these companies will take an invoice and they actually sell the invoice to the factor. Now the customer doesn't pay the company, the customer pays the factor. But the factor gives the fashion manufacturer the money right up front. All right. Now there's a price for this. Factoring is very expensive because factors then take all the risk of collection on themselves, and they have their own return on investment goals that might be higher than the fashion manufacturers. So it wouldn't be unusual in a factoring situation if you sell an invoice to a factor at $1,000 face value, the factor might only give you $750 for it. Okay. It's expensive, but would you rather have $750 now or $1,000 5 months from now? That's how this runs. Then finally, another way to accelerate cash is to use a lockbox service. This matters if your cash flow is big enough that 1 or 2 days of float makes a difference in how fast you get the cash and how much you need to use it. In a lockbox, the customer sends the money to a PO box number. That PO box number is collected by a bank, and the checks are processed in the bank's daily activity and credited to your account overnight. All right. So that will speed up the cash coming in. Now, this is a matter of days. It's 1 or 2 or 3 days. But if you're in a business that does 30 or 40 billion dollars worth of business a year, that 1 or 2 days worth of fast cash results in quite a bit of float income, because your treasury department in a business that big is always investing excess cash in very small returns. It's small amounts of interest, small amounts, but those add up when you're moving billions of dollars through that process. Now, for you, this usually makes sense when a business is doing, several $1 million a year worth of activity. So but it does speed up your availability of cash. Now, how do you decelerate the cash going out of the business? First of all, you have to slow down your vendor payments. Now, that's easy for me to say, right? But in reality, you can analyze your vendor list very carefully, and you can determine who your most important vendors are without too much trouble. Your A-list vendors, those are the guys you want to stay on really good terms with. You want to be right within terms with them all the time. They might not be, some of them might not be your biggest vendors, but they're critical to your business cycle, so you want to take care of them. You also want to talk about who your B-list vendors are. Those are the people that, yes, they're good, but we don't buy from them all that often. We have their stuff on the shelf. We don't need them today to be in terms, and we could slow pull them, but we do want to talk to them. Your C vendors also, the last time we bought from them was 2 years ago. If we buy from them again, blah, 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 we can afford to slow pull them a little bit. Now, the issue is here that you have to communicate. You have to tell your story. You have to call your A-list vendors and say, my cash flow forecast says I'm short a little this month. Can I extend a week or 2 weeks, whatever you've calculated that you think you need? Calculate what you think you need, add a little cushion to that, and then ask for that extension. All right. That's a temporary thing. We're talking about decelerating cash flow beyond the normal course of business. And you've got to be able to then say to your vendor, my cash flow forecast says, if you do this for me, I can pay you in full 2 weeks later. Okay. Or a month later. And I'll pay you in full when I pay you. And that gives them the confidence that you are watching your cash flow, that you are carefully prioritizing, that you're monitoring, that you're paying attention to your business, not just selling. All right. Same thing with your B vendors, same thing with your C vendors. You have to communicate, you have to tell the story. All right. And by telling the story, you make your vendors more comfortable that you're on top of your business. Now, what else do we do to decelerate cash flow out? We cut expenses. Yeah, that's easy for me to say, right? But again, you analyze what you're doing carefully. You analyze your expense ledger carefully. You analyze your payroll carefully. Who is doing what? Can we do without that for a period of time, whatever it is? Who are the critical people we have to keep aboard and take care of? Who might be furloughed for a period of time? And finally, who unfortunately do we have to let go on a permanent basis because we can't afford them anymore? It is the hardest thing in business for a manager to have to cut staff. These are people who may have been with you for many years. These are people who are doing worthwhile jobs in a competent fashion, but the business can't afford them. And that is very, very hard to do, but has to be done in certain circumstances. You want to analyze what your outsourcing opportunities are. You can outsource almost anything these days. Almost every part of your business can be outsourced. But what you want to look at is, where in my business do I add the most value for my customer? What is it that our business does that our customers find most valuable? Keep that inside the business and look at everything else as a candidate to outsource. Marketing, outsource. Advertising, outsource. Human resources, outsource. Bookkeeping and accounting, outsource. All right. All those ancillary, what I call staff functions, can be outsourced. Now, marketing and advertising, well, your advertising perhaps, but your marketing, your strategies, your plans, and so forth, that may be something you want to keep inside alongside that core business value creation for your customers. Okay. Then you figure out what you can do without. What do you do without? What can you do without? Then, most of all, don't eliminate your marketing. You still have to keep going to customers. You still have to be able to do what your business does. All right. And that is something that you really, really have to focus on and make sure you don't eliminate. Keep that in mind all the time. Now, we get emergencies, like an emergency I just had. You'll have to excuse me for 1 second. I'll be right back. Quiet, please. Thank you. We're back. Now, in an emergency, what you need to be doing is decelerating your cash out, correct? To do that, you have to talk to your vendors. You have to get forbearance from your vendors. You have to talk to your landlord. You have to negotiate with them to slow down what you're going to owe them. The whole point of this is to delay now and catch up later. Now, what lets you do that? What lets you have the confidence that you're going to catch up later? It's your cash flow forecast, right? Update it, keep it updated, keep it rolling forward. The whole point here is delay now, catch up later. And that's your message to them based on your cash flow forecast, right? It's the same thing with your banker. You do that in order to get some breathing room, get a little room, because your cash isn't coming in. You have to slow down your cash going out. Now, to get the cash coming in, to accelerate that, if you're in a service business, talk to your customers about a prepaid service contract. You'll give them an extra month of service if they prepay for 12, right? That's very common. If you're in a business where you're doing something regularly for a customer, talk about prepaid subscriptions. If you commit to me for a 12-month period, I'll give you 2 months free if you pay now. If you're a restaurant, sell gift cards, right? Gift cards that let people come back in and claim a meal later, not today, later. All right. If you're in the kind of business where you work on contract to somebody, landscapers and things like that, talk about requesting advanced contract payments, right? So that you can reserve your efforts on their behalf when they need them. That's the value exchange there. Okay. It's not just to speed up your cash flow. It's to give them the confidence that you're there when they want you, when they contract for you to be there. Finally, look at disaster and relief loans as a way of accelerating or bringing in some additional cash. In the latest round of pandemic relief programs, the payroll protection program is one of the most successful. There's $580 billion in loans to companies under the payroll protection program. And guess what? Those loans can be forgiven if you spend the money on the right stuff. forgiven completely. There's also what are known as economic injury disaster loans. These are loans administered directly by the Small Business Administration, which has been doing this for 50 years now. And they are intended to provide relief for economic injuries suffered as a result of a disaster, like hurricanes. These are big in hurricane country, okay? And they bring cash in. It's beyond the scope of what I'm talking about today to talk anything more about those, but talk to your NMSBDC counselor or talk to the SBA directly about those programs and what they might be able to provide for you. Now, those programs require you to keep records, not just your checkbook, but real accounting records so that you stay up to date. Keep your basic bookkeeping up to date, because all these programs, the state program for relief, the restaurant relief fund, the small venue, the shuttered venue operators grant program, the New Mexico state grant programs for small business relief, they all have audit requirements in them. They all have audit provisions where they can come to you later and say, you know, that grant you got, show us what you spent it on. Did you spend it on what we wanted you to spend it on? If you did, it's a grant, we'll forgive you. If you didn't, we may want the money back, or we may want you to pay it back over time. That's the basis of the Payroll Protection Program, PPP, okay? Every kind of money that you get from a relief program has requirements as to what they want you to spend it on and by when in many cases, okay? So you've got to account for that to show that you did spend it on what it was supposed to be spent on, and you spent it when it was supposed to be spent. To do that in your accounting system, establish sub-accounts for each loan or each grant that you got, and then track sub-accounts in your expense ledger and your cash flow ledger so that you can show sub-account grant 1, okay, expense grant 1, expense grant 1, expense grant 1, sub-account grant 2, sub-account expense grant 2, expense grant 3. Be prepared to be audited. Even if you never get audited, you'll still be prepared if necessary. Now, beyond the basic bookkeeping, the records that come out of your computer, you're going to want to keep actual payroll records, actual payroll ledgers, actual payroll check copies, actual copies of Form 941s, payroll tax forms, and so forth and so on. You're going to want to keep a copy of your lease handy. You want to keep a copy of all your utility bills handy. Those are part of proving evidentially, to coin a word, that you did pay those bills. Keep copies of invoices. The feds are always looking for evidence of payment or receipt. And you want to make sure that you have those, you have them organized. Now, to do that, you want to work with your CPA or your bookkeeper to set up that process, to set up those files so that you know that they are easily accessible. And when the auditor asks for thus and such, you can give them thus and such very quickly without too much trouble. All right. Now, there are more resources about cash flow and how to accelerate and decelerate your cash flow. I'm not going to go over these individually, but they're in the copy of the slides that you'll get after this program is over. I commend you to albuquerque.score.org. I commend you to the New Mexico Small Business Development Centers, nmsbdc.org. I commend you to the U.S. Small Business Administration for more information on this topic. Now, there's also COVID resources available to you at all of the resources listed here. And again, I'm not going to go into these in any level of detail. They'll be in the copy of the slides that you get after the program is over. Now, to contact NMSBDC, you can go to the website, nmsbdc.org. Have I said that enough today? Or you can call them up. The phone numbers are there. They're in the copy that you'll get, or the email address is info@nmsbdc.org. To get a hold of the SBA or contact them, it's sba.gov at the website. The 800 phone number is listed there. The email disaster customer service at sba.gov, and that will get you people who are familiar with the economic injury disaster loans portion of SBA. I want to acknowledge a few people here for this. First is a guy named Philip Campbell. He's the author of a book called Never Run Out of Cash. If you go to his website, neverrunoutofcash.com, you'll find some interesting information. And he's got a free copy of the book there if you want it. Now, he is selling you other things beyond that, but keep in mind that Just Never Run Out of Cash is a very good primer on cash flow management. The National Federation of Independent Businesses contributed to this. So did Inc. magazine. Some of the research that we did get in preparing this program came from them, and they're listed in the resources page that we just came past. Also, I recommend the SCORE Association's Albuquerque chapter. We have partnered with the New Mexico SBDC. I'm a SCORE volunteer to produce this program and others. Finally, want to ask if anybody has any questions. And Leslie's been monitoring the questions section all day. Leslie, do we have any questions?
We don't have any questions. I'm going to give everyone a chance to, you can either raise your hand if need be, if you have a question you'd like to ask, or type it into the Q&A. And while we're waiting for the questions, if any come in, I want to remind everyone that we have all kinds of webinars available for you and your small business. We have Eric Spellman. He does quite a bit on getting found online, Google searches, should retailers sell their product online. We also do a bilingual session, 2 of them. We do one transitioning to the new normal. We also do another bilingual session, accessing financial resources. We also have Larry Donahue and Ian Alden, they're seasoned attorneys here in New Mexico. They're coming up with Before You Sign, Examine Your Contract. And at the end of the month, they're doing a webinar on LLCs and how to pros and cons of that. So I don't see any questions coming in. Do you have any wrap up, Tommy, before we pop off today?
Sure. First of all, I want to thank everybody for your attendance today. I appreciate it greatly. Please feel free to contact us. We've given you plenty of contact information, and thank you very much for your attendance.
Thanks, everybody. I want to remind you that I
have one more
Yep.
point to make, Leslie. I'm sorry.
Okay, that's okay.
And that is what's next. Today was a spoonful of ice cream, if you will. Take the next step, fill your bowl, find out more about cash flow management, and put it into effect. Go home today and start building your cash flow forecast. Do it now. That helps you get your story straight when you have to talk to people about cash flow. If you do that, you're going to be massively ahead of anybody else in business alongside you. Your competitors won't do this because they weren't here today. And you'll be able to communicate your cash flow situation, your needs, and your success much more effectively to the stakeholders in your business. So thanks everybody for coming. Leslie, I'll turn it back to you for the last moment.
Yes, there is one question there is one question. I do want to remind everyone that we will send a copy of the handouts for Tommy's webinar today. It also can be, I chatted over the link. You can find it on our website. Last question before we pop off. Great info, Tommy. Thanks, from Kyle. What are the keys to helping clients who have a goat rodeo with intermingled personal and business finances to help their cash flow? Don't know if we can answer this real quickly, but I'm going to give you a chance to try.
The middle of that question, I didn't get the bit. Can you repeat the question?
Sure. What are the keys to helping clients who have a quote unquote goat rodeo with intermingled with intermingled personal and business finances?
Yeah. The first thing I say to everybody is to separate those. Yes, you've been working out of one checkbook. I understand that. But take a point in time at some point ahead of time, establish a business bank account, start taking cash into your business bank account, start taking cash out of your business bank account for expenses. When you take money out of your business bank account so you can buy groceries, record that as owner draw from your business, and then put that money into your personal checking account and pay your personal expenses from your personal checking account. That goes a long way towards helping you separate things so that your accountant or your tax preparer at the end of the year doesn't go absolutely raving crazy trying to separate them then when she has 1,300 other clients, all of whom need their taxes filed by April 15th. So separation is the key. Get separate. If you're a sole proprietor, consider starting an LLC. That helps protect your personal property, your personal estate from being sued and being lost in a suit or bankruptcy because of something that was done in your business. Separate, separate, separate. That's the key to the whole thing. Okay. So the basics are to start a business checking account, put business receipts and business expenses through that account, take your owner draw out of it, put that in your personal account, and then pay your personal expenses from your personal account. That's it. That's it in a nutshell. So, Leslie, thank you. And again, thank you, everyone. If there aren't any more questions, we'll call it a day.
And we will
appreciate-
see you. Yep, we will see you next time, everybody. You guys have a great day. Thanks, Tommy.
Bye-bye now.
Bye.